Imagine a life where you wake up without the insistent nudge of an alarm clock, where your time is truly your own, and where financial worries fade into the background. This is the promise of financial independence, a state of being where your passive income surpasses your expenses, affording you the freedom to pursue your passions, spend quality time with loved ones, or simply enjoy the luxury of unstructured time. It's a goal that resonates with many, yet the path to achieving it can often seem shrouded in complexity and uncertainty. Embarking on any journey, especially one with significant financial implications, requires a well-defined roadmap. Dividend investing is no different. Before diving headfirst into stock selection and portfolio construction, it's crucial to establish a clear understanding of your financial aspirations. What does financial independence look like for you? Before diving into the intricacies of dividend investing, it's crucial to establish a clear understanding of your financial destination. In the realm of personal finance, this often translates to determining your financial independence number, the magic figure representing the total amount of investments you need to accumulate to cover your living expenses solely from passive income. This number is as unique as your individual circumstances, encompassing factors like your desired lifestyle, current expenses, and future aspirations. One of the most compelling aspects of dividend investing is its ability to harness the power of compounding, often referred to as the eighth wonder of the world. Compounding, in essence, is the snowball effect of earning returns on your initial investments, as well as on the accumulated interest or dividends. Over time, even small amounts invested consistently can grow exponentially, creating a virtuous cycle of wealth accumulation. With a clear understanding of your financial independence number and the power of compounding and dividend growth, you're now equipped to craft a personalized dividend investing plan tailored to your unique goals, risk tolerance, and time horizon. This plan will serve as your roadmap, guiding your investment decisions and ensuring you stay on track towards achieving financial freedom. Begin by determining your investment timeline. Are you aiming for early retirement in 10 years? Or are you content with a more gradual approach over 20 years or more? Your time horizon will significantly influence your asset allocation strategy. In the realm of finance, time is often likened to a powerful ally, particularly when it comes to the magic of compounding. Just as a tiny seed planted in fertile ground can blossom into a towering tree over time, so too can consistent dividend investments grow into a substantial source of passive income, given sufficient time to flourish. This is the essence of the time value of dividends. The longer your investments have to compound, the more significant their growth potential becomes. While the allure of achieving financial independence in record time is undeniably tempting, setting realistic timelines is crucial for maintaining motivation and making sound investment decisions. Remember, dividend investing is a marathon, not a sprint, and patience is a virtue that pays handsome dividends in the long run. When establishing your dividend income timeline, consider factors such as your current financial situation, savings rate, risk tolerance, and desired lifestyle in retirement. If you're starting with a smaller investment amount and a modest savings rate, it's essential to temper your expectations and allow ample time for your investments to grow. Conversely, those with a higher risk tolerance and a larger initial investment may be comfortable with a more aggressive timeline. As humans, we are wired to respond to visuals. A compelling image can often convey more than words alone. When it comes to planning your dividend income timeline, visualizing your desired future can be a powerful motivator, helping you stay focused on your goals and make sound financial decisions. Imagine yourself a decade from now, financially secure and enjoying the fruits of your dividend investments. Perhaps you're traveling the world, pursuing a long-neglected passion, or simply relishing the freedom to spend quality time with loved ones without the constraints of a 9-to-5 job. Whatever your vision of financial independence may be, paint a vivid picture in your mind, engaging all your senses to make it feel real and attainable. Navigating dividend investing involves balancing between companies that prioritize growth and those with high current yields. Both have distinct advantages and drawbacks depending on your financial goals, risk tolerance, and investment timeline. Dividend growth stocks consistently increase payouts, offering long-term income potential. Their modest yields can grow substantially over time, especially with compounding. In the early stages of building your dividend portfolio, particularly if you have a longer time horizon until retirement, prioritizing dividend growth stocks can be a prudent strategy. These companies, often characterized by their commitment to reinvesting profits back into the business, are well positioned to generate sustainable earnings growth, which in turn fuels future dividend increases. By focusing on dividend growth, you're essentially planting seeds for a future forest of passive income. Section 3. Transitioning to income high-yield stocks for financial independence. As you approach financial independence and transition into retirement, your investment objectives may shift from accumulating wealth to generating a consistent and reliable stream of passive income to cover your living expenses. This is where high-yield stocks can play a valuable role in your portfolio, providing an immediate boost to your cash flow. Section 1. The 4% Rule, a safety net for retirement. Navigating the financial landscape of retirement planning often feels like setting sail on an uncharted sea, with uncertainty lurking around every corner. How much money is enough to sustain a comfortable lifestyle for decades to come? How can one ensure their hard-earned savings will weather market storms and outpace inflation? These are questions that have plagued retirees and pre-retirees alike, prompting a search for guidance and reassurance. Enter the 4% Rule, a widely adopted guideline designed to provide a framework for sustainable retirement withdrawals. Section 2. Dividends. Enhancing the 4% Rule for sustainable income. While the 4% Rule offers a valuable framework for retirement withdrawals, it traditionally relies on selling a portion of one's portfolio each year to generate income. This approach, while viable, can be unsettling for retirees who prefer to preserve their capital and rely on passive income streams. This is where dividend investing emerges as a compelling complement to the 4% Rule, potentially enhancing its sustainability and reducing the need to tap into principal. Mastering the art of dividend investing for retirement income often involves a delicate balancing act, knowing when to reinvest dividends for continued growth and when to harness their power for living expenses. This decision hinges on various factors including your time horizon, income needs, and overall financial goals. During the accumulation phase, typically, the years leading up to retirement, reinvesting dividends back into your portfolio can be a powerful strategy for accelerating growth. By opting for a dividend reinvestment plan or DRIP, you automatically use those dividend payments to purchase additional shares, leveraging the power of compounding to amplify your returns over time. This approach is akin to planting seeds and letting them multiply, creating a lush garden of dividend-paying assets. Reaching financial independence, where passive income surpasses living expenses, marks a significant milestone. It's a moment where employment constraints loosen, paving the way for a life on your terms. This freedom presents a pivotal crossroads, reinvesting dividends for growth or using them for your lifestyle. It's about weighing immediate gratification against potential exponential growth. For those who prioritize long-term growth and envision a future where their passive income stream continues to expand, reinvesting dividends emerges as a compelling strategy. Just as a gardener diligently plows their harvest back into the soil, enriching its fertility for future seasons, so too can reinvesting dividends fuel the growth of your investment portfolio, compounding your returns over time. This approach, often facilitated through dividend reinvestment plans or DRIPs offered by many companies, automatically uses your dividend payments to purchase additional shares, harnessing the power of compounding to accelerate your wealth-building journey. Each reinvested dividend, in essence, becomes a tiny seed planted in fertile ground, poised to sprout and flourish, generating even more dividends in the future. Navigating the crossroads of dividend reinvestment versus cash flow is not always an either-or proposition. In reality, the optimal approach often lies in finding a balance. a strategic blend of both strategies that aligns with your individual circumstances, risk tolerance, and evolving financial goals. This might involve a phased approach where you prioritize dividend reinvestment during your accumulation years, maximizing growth potential while you're still earning an active income. In today's fast-paced world, automating routine tasks is essential for maximizing efficiency and reducing stress. This is especially true in dividend investing, where consistency and discipline are key. Modern brokerage platforms offer tools to automate your dividend portfolio, freeing up your time. Imagine your investments managing themselves with minimal effort on your part. Automation empowers you to build wealth passively with a hands-off approach. Two powerful tools that form the cornerstone of automated dividend investing are dividend reinvestment plans, or DRIPs, and automatic investment plans. These features, readily available through most reputable brokerage platforms, empower you to streamline your investment process, ensuring consistent contributions and maximizing the benefits of compounding. DRIPs, as the name suggests, automatically reinvest your dividend payments back into the underlying stocks or funds, purchasing additional shares at the prevailing market price. This eliminates the need for manual reinvestment, ensuring those dividends are immediately put to work, generating even more dividends in the future. Section 3. Staying informed, monitoring, and adjusting. While automation can significantly streamline your dividend investing journey, it's essential to remember that it's not a set-it-and-forget-it endeavor entirely. Regular monitoring and periodic adjustments are crucial to ensure your portfolio remains aligned with your financial goals, risk tolerance, and evolving market conditions. Think of your dividend portfolio as a garden that requires occasional tending, even with the help of automated irrigation systems and self-fertilizing soil. While those tools can undoubtedly minimize your workload, a keen eye for potential issues such as overgrowth, pests, or nutrient deficiencies can make all the difference in ensuring a bountiful harvest. Section 1. The importance of vigilance. In the world of dividend investing, it's easy to be lulled into a false sense of security by the steady stream of passive income flowing into your portfolio. After all, you've meticulously selected companies with robust track records, solid financials, and a history of sharing profits with shareholders. However, even the most seasoned dividend investors understand that vigilance is not a luxury, but a necessity, particularly when relying on those dividends to fund living expenses or achieve long-term financial goals. Identifying potential dividend cuts is crucial for any investor, allowing proactive portfolio adjustments. Several red flags often precede a company's decision to reduce or eliminate its dividend. Recognizing these signs provides insights into a company's financial health. A decline in earnings is a telling indicator. Even with the most diligent monitoring and analysis, dividend cuts can still occur, sometimes catching even the most seasoned investors off guard. However, the key to navigating these situations successfully lies not in avoiding them altogether, but in having a plan in place to adapt your strategy, mitigate potential losses, and ensure your long-term financial goals remain on track. The first step, as with any investment decision, is to avoid emotional reactions. Panic selling in response to a dividend cut, especially if the underlying business remains fundamentally sound, can often lead to locking in losses and missing out on potential future growth. Instead, take a deep breath, review the company's financials, and assess the reasons behind the dividend cut. Financial freedom is not an elusive dream reserved for the wealthy few, but an attainable goal for anyone willing to embrace patience, discipline, and long-term thinking. By harnessing the power of compounding and reinvesting dividends, you're planting seeds of financial security and reaping the rewards of a more abundant future. Imagine a life where your passive income surpasses your living expenses, granting you the freedom to make choices based on passion. This is the allure of financial independence, where work becomes an option, and time is a valuable currency for experiences and personal growth. As you embark on your dividend investing journey, remember it's not merely about accumulating wealth but about cultivating financial empowerment, taking control of your financial future, one dividend stock at a time, and watching your portfolio transform into a powerful engine for passive income. Celebrate the milestones along the way, the first dividend check received, the realization that your passive income is steadily growing.